Hello everyone, can you guys hear me? I see the first of you are entering the room now. I see Chuck and Andrew, Jacob, Christina, Mike, Louis, Tom, Camilo, Mark, Kenny. Welcome everyone. There is a chat function. You can use that if you have any questions or right now it would be nice if you could tell me if you guys can hear me well enough. Okay, good. Chuck hears me, so that's a start. So I see that more and more people are pouring in. We'll just wait a couple seconds till everyone's in. Okay, cool. Seems like most people can hear me. That's good. So while we're waiting for the rest of the people to join, I would always like to ask where are you guys from? Because last time we had people from all over the world, from a lot of people from India, a lot from the US, of course, because that's what my website is mainly focused on, of course. US stocks. I myself am from the Netherlands, actually, a very little country in Europe. I live in the capital, Amsterdam. You probably heard of that. It's a great city to live in, and it's not as how can I say that? It's not as cheeky as you might think. It's a great city, and most of the tourists do all the stuff that you shouldn't do. Singapore, 2 people from Singapore, Thomas and Andrew. UK, California. I would love to go to California, Chuck. My girlfriend went to school there. Jason is also from Singapore. Wow. A lot of people from there. Okay, let's see how many people we have now. Okay, I see that like 290 people registered and 40 of them are live now. So let's get this show on the road. Oh yeah, so Germany, India. See 2 people. Yeah, Czech. I will stop by whenever I'm there. Probably go there someday. Pretty sure. So like I said, let's get this show on the road. Thanks for joining me today. Because of the time zone difference, as I said, I'm located in Europe, and I have my audience is mainly from the US, so always struggling with the time zone differences. So actually I'm sitting here, it's 7 o'clock in the evening now, so I've already had a full workday behind me, but I still have enough energy left to guide you through this presentation. So let's go. The presentation, how to analyze stocks the fast way, and why I say fast, I'll show you in a sec later in this presentation, because we're going to analyze a lot of stocks and you guys are going to be able to shout out some stocks that I then analyze for you on the spot. But before that, let me just, for the people who don't know, this is me. It's an old picture. I don't have the beard anymore. I should update this one. But my name is Nick. I'm the founder of valuespreadsheet.com. Super excited to be here with you guys. I always love these presentations, these live webinars, especially for the interaction, it's great that we have this chat function. You guys can ask me questions. I can then customize the content of this presentation to what you guys want to learn, because I can think about a lot of things to talk about, but if there's certain things you want to know, just ask and I will try to fit it in. So today I will show you how you can analyze stocks in a very fast way. And at the end of this webinar, you will know exactly how to do this and how to, for example, calculate the intrinsic value of a stock, which is something that I get a lot of questions about. Yeah, so I'll try to teach you as much as possible in the coming hour, and after that I'll show you how you can get more help if you wish, and there'll be plenty of rooms for questions, but let's get to the main content. You all know this guy, Warren Buffett, and this is the quote that I probably think describes his investment philosophy best. Warren Buffett is one of the richest people in the world, several billion in assets. And he said, whether we're talking about socks or stocks, I like buying quality merchandise when it's marked down. In essence, he says, I want a quality business and I want it cheap, just like he buys his socks. So that's his strategy in a nutshell. So I've been studying the strategies of a lot of other value investors. Value investing is the strategy practiced by Warren Buffett, and there's a lot of other people who also earned a ton of money by applying this strategy. Among them, Benjamin Graham, the father of value investing, Warren Buffett, who I just mentioned, Manish Babrai, Philip Fisher, John Templeton. You may have heard about some of these legendary investors before, and I studied them for years. And even though the details of their strategies differ, they all base their strategies on these two key questions we have on the screen here. So the first one is, how well is the business performing? And the second one, how much is the business worth? So do we have a quality business, and is it cheap? So going back to Buffett's quote, So this is the value investing strategy that all the investment grades employ, and it's based on finding answers to these two key questions. So how can you tell how well a business is performing? Which is question one. Well, it's not very, I was going to say it's very simple, but it's not really, because what you have to do, the only way to figure out how well a business is performing is to look at their performance metrics, which can be found in the so-called financial statements. A financial statement is a document that each company has to hand in to the authorities at the end of the year or every quarter, and it describes how much revenue they generated, how many the costs that were involved to create that revenue, and then in the bottom line, the net profit that remained or net loss. And it also describes things like, okay, how much does this business actually own? Like, does it own buildings? Does it own computers? Does it own real estate? That's all on the balance sheet, which is also a financial statement. So let me just quickly show you one sec. Let me see. I'll just quickly want to show you, because I see that someone said, tell us something new. Obviously, most of you know about financial statements, but some of you might not, because I have people people who read my emails, and you are among them. Some people just get started, they just dip their toes into the investment world, and they have no clue where to begin. They have never heard about the term financial statement, even though it's basic, of course, to some of you. But let me just quickly go through some good resources for finding these financial statements. Let me see. I'll just quickly exit this presentation for a second, and I'll show you some great resources. So one of them I use all the time is Guru Focus. I'll also type them out for you in the comments, because otherwise people might not know what I'm saying. gurufocus.com. So Guru Focus is a great website where you can get a lot of data surrounding companies. So let's look for Apple here, the ticker symbol AAPL. Go to the summary. So what you see here is a ton of metrics. Like, you can find everything. They have their trademark annoying pop-up. But the real thing, the financial statements, can be found here. It says 15-year financials. And here you find, does this pop up? It's killing me. Yeah, so let me see. We at the top here we have income statement. So you see that they say 15 years, but you have to pay to see all the 15 years. But at least you can see the 2012, 13, 14, 15, and the TTM, which is trailing 12 months. So that's like the last data from the last 12 months. You can see revenue, gross profit, operating income, net income. So all this data is very, very valuable, but it is a lot of data, as you can see, because this is just the income statement. When we go down, we see the balance sheet. This is where you see, okay, for example, this first line item, cash and cash equivalents. How much cash does this company hold and own? Like machinery and land and buildings. That's all on this thing. And then we have another one, the cash flow statement. So as you can see, I have to scroll down quite a bit. This is all data relating to this particular business, Apple. So you can imagine that it's not easy to sift through all this data to figure out the answer to question 1, which is how well is the business performing? There's not a single value you can look at. You have to go through it. Another good one that I use all the time is Google Finance. Let me see, com/finance. So I'll type that out for you too. That's google.com/finance. Yeah, I heard this before, that the visibility of when I show like these detailed web pages, it's not very visible to everyone, but that's why I type the websites out in the comments so you guys can open them yourself and see. Let's see. It's just because this is live streaming of video, you know, and the quality just isn't the best it can be. Yeah, so what you can see here, I looked up Apple again, and then we have another button here on the left which says financials. If you click there, you get the income statement, the balance sheet, and the cash flow from the last 4 years or the last 4 quarters. So this is where you find this information, and there are more. Let me just type them out for you quickly, instead of just going there. Finance. Then you can look at them yourself. They all offer sort of the same features, but some of them offer just things you can't find anywhere else. So it's worth checking out all of them. Let me see, what other one do we have? Jetta.com is one of my favorites. So I just showed you a couple of them. Let me just go to this last one that I mentioned, Jetta.com, because the cool thing about Jetta is that they're really focused on value investing. So their whole strategy, all their data, the way they display it is all related to value investing. And as you can see, they also focus on the key 2 questions of value investing, which is how to buy a wonderful company at a fair price. That's literally what it says here on their website. And they brought it down to 2 key indicators: a score, which says from 0 to 10, how well is the company performing? And then the second one, which is the price, displayed by this line on their graph, which says like, okay, what is the intrinsic value of this company? What is this company really worth? Which is the answer to question 2. Okay, so now that you have all these resources to find all this financial information, let's go back to the presentation real quick. Presenter's view, and I'll maximize it. Yes, there we go. And we're back. So, yeah, so when I first learned about this value investing strategy many years ago, I understood that a systematic approach could be of analyzing all this data that you just saw, that could be made a lot more efficient by using some spreadsheets. So I opened Excel, I created some spreadsheets to do some calculations. I just, looked up a stock on one of the resources I just showed you, for example, gurufocus.com, and then filled in all the details, all the figures manually into my spreadsheets. And it was a mess because, it's very easy to, it's not just boring and time consuming, but it was also very easy to make mistakes when entering data. And yeah, I actually at some point bought a stock based on my calculations, which said it was a great company, but then later I figured out I typed a zero too many, and that's painful. So I started looking for a way to solve all these issues, and my first idea was to just merge all the spreadsheets I had together into one. So at least I no longer had to fill in data, the same data, several times. So that helped a bit. But then I realized, how amazing would it be if I could draw in all the required data, financial data, into the spreadsheet automatically. So after several sleepless nights of programming, I finally succeeded, and the result was the very first version of Value Spreadsheet, a tool which allowed me to analyze stocks in seconds instead of hours, thanks to automatic data retrieval and smart calculations. And yeah, I successfully used this spreadsheet for several years for my own investments. And at some point I decided, wait, maybe other people might benefit from a tool like this as well. So we are now several versions further, and Value Spreadsheet has evolved into a powerful investment tool that anyone can use on any device with an internet connection, because it is powered by Google Documents. So with Excel, you would have to install all kinds of plugins to get this financial data in, but Google Documents supports these features natively. So now I would actually like to just get to the point and show you the Premium Value Spreadsheet and how it helps me to analyze stocks in a matter of seconds. And I will first run you through the most important features, and after that you guys can shout out some tickers that some stocks that you want me to analyze. So what you see here, this is the main dashboard screen of the spreadsheet. There's a big login button. Once you press that, it will tell you, okay, you're authorized, you can log in, you can use the spreadsheet. What you see here is the data for Apple, but it's very easy. I can just type in this top thing, I can just type in Microsoft, and it will take a couple seconds, and there it is. It loaded all the data for Microsoft, and it performed calculations and shows you the new results. So remember the two questions, right? How well is a business performing? And the second question, how much is a business worth? So you see a score, which is calculated based on an analysis of the financial statements that we just saw. So all this data is compressed into this one score here, 0 to 100. 100 being a perfect company with perfect figures, perfect profit, perfect debt, everything. And so in one glance, you can see, okay, this is not just, this company is worth investigating further. So that answers question one, the score. And then on the right here, you have an answer to question two, which is, how much is this company worth? Well, for that, we calculate the so-called intrinsic value, which is also sometimes called the fair value. So how much should this business realistically be worth based on its profitability, on its debt levels, and all that kind of stuff, its cash flow. The reason why there are three different valuation models, which all three show a different valuation, is because valuing a company is more art than science. There's no perfect formula for it. So the only way to get a feel for the ballpark figure of what is the intrinsic value of this company, how much is this company worth, is to use several methods and then just get the average, or get a feel for it. Because Charlie Munger, who is Warren Buffett's business partner, he actually says it's better to be roughly right than precisely wrong. And I truly believe in that. So you don't need to know the value of a company to 10 decimal points, but if you know that it's probably worth closer to 50 than 100, that's already a good indicator. That's already more than a lot of people go on when they buy stocks. So, but this is just the dashboard. Let me just quickly fill in another one. I'll do this one for now. Bed Bath & Beyond. Takes a couple seconds to load the data, and boom, there it is. As you can see, it scores 80 out of 100. Pretty good. Let's just go to the rest of the spreadsheet real quick. I won't bore you guys too much with it, but I'll just quickly hop through it. Because what you see on this dashboard page is just a summary of everything that happens behind the scenes. Because first, it imports the financial statements we just saw. He does this fully automatically. So we have the income statement of the last 4 years, the balance sheet of the last 4 years, and also the cash flow statements. A lot of data to work with. But on top of that, we have another tab with even more data inputs, like what is the current price, the earnings per share, dividend yield, current ratio, growth rates, a lot of stuff. And even because a lot of people say, okay, 4 years of financial statement data is not enough to make a generalization about, okay, how well will this business perform in the future? How stable has it been in the past? So what we do here is we get the key financial ratios, 10 years worth of them, and actually, use that to make a better assessment of how this company has performed in the past. You can actually look at 10 years and you see that the return on equity has been consistently above 15% over the last 10 years, which is incredible. So this company, that's why this company scores 80, out of 100. But then there's also people who think, okay, return on equity, what is that? Why do I care? So we have this tab here, the analysis tab. This is where we see return on equity is being analyzed. It's 31.7 for this year. And then it says it's good, average, or bad. But not just that, it also shows you why it's good in this case. It says return on equity is consistently high. The company capital is invested profitably. So this helps you to, even if you have no experience with investing, where a lot of platforms or financial websites or whatever, they just show you return on equity, 31%. And you're like, okay, and now what? Is that good? Is that bad? Why? That's why I added this analysis tab to the spreadsheet to help people who are just starting out, or who just need a refreshment of, okay, the current ratio, why do I care? So very helpful. And then my favorite one of all, everyone who invests in stocks loves graphs. At least that's my general feeling after having been active in this market for a couple years. So you remember the 10 years of key financial ratios that I showed you. This is them plotted on a graph. So it gives you a great overview very quickly to see, like, where is this company going. Like, this is the earnings per share and the free cash flow per share, which just shows profitability. And you just see an upward trend, which is always good, of course. Like, you want profits to grow. So that's great. Book value per share had a little dip here. That's something to watch out for. This is a great one too, the shares outstanding. You see it's declining, like, straight down, which means that the company is aggressively buying back shares. When done at the right price, that can be super profitable for you as a shareholder. Another one I usually look at is the current ratio. For those of you who don't know what that means, it's sort of a measure of short-term obligations versus short-term, yeah, like it sort of says like, am I able to pay my short-term obligations with what is coming in or what I have on my balance sheet? So that's a very good measure of like, if it's below 1, it means that the short-term obligations we are not able to meet our short-term obligations, which is of course a very bad sign. So yeah, I love these charts. This is always the first. Of course, first you look at the dashboard, and then usually how I go about it, I fill in the ticker symbol. Let's fill in Dolby. Takes a couple seconds to load. There it is, very quick. Just literally a couple seconds. That's why I call this how to analyze stocks the fast way, because this is real quick. And like I said, it's not an end all, like it's not, okay, I see it has a good score, it is cheap according to the spreadsheet, so let's buy it straight away. No, this is just the start, but it helps you to very quickly weed out the terrible stocks, because there are 10,000 stocks available. How can you possibly analyze all of them? So with this, you can very quickly run through a couple of ticker symbols and then just get a general feel like, okay, if it doesn't score above 70, I'm not gonna even invest another minute into analyzing this stock. It just won't pay off, So that's how it really helps you speed up your analysis process. But yeah, like right now I see, okay, return on equity, bad. And then I usually go to the graphs and I look at the return on equity and I look like, okay, what's bad about it? Well, it's been declining for at least 4 years straight, and it has dropped below the 15% that we like to see there. That's sort of what Warren Buffett also wants to see. 15% return on equity is considered pretty good, especially if it's consistently over the last 10 years. But yeah, you see it's declining, profit margins declining. Not a very good sign. Yeah, so let's quickly go through these last few tabs. They're just the, you saw the dashboard had 3 valuation models, and these are just the valuation models in detail. Just to explain what these orange fields mean, they are override fields. So automatically we gather this data from Google Finance. It says the earnings per share for Dolby are $2.04. If you think, nah, that's not right, I'll fill in $5, and it overrides it, and you see it changes the valuation at the top. So that way you have some influence on these things, like it calculates this valuation based on an industry average price earnings ratio of 22. If you think, nah, that's way too high, I think it's closer to 18, you see the valuation turns out lower. This also really shows you though that garbage in, garbage out. Like if you don't have the right inputs, there's no way you can trust the output. So be very careful, always stay on the conservative side, So if I look at the dashboard and I see these valuations, 41, 28, 23, don't say, okay, it's worth 41. That's not being conservative, Say it's probably 28 or even closer to 23. That's being conservative. Then we have the discounted cash flow, one of the other valuation models that's included. And then finally, one that's not used very often, but which offers a different perspective. It's a valuation model based on return on equity. And I've written a whole ebook about the valuation models. And if you're an email subscriber, you've either already received that ebook or you will receive it in the near future. Yeah, I see a question like, where do I get the link to the spreadsheet, or where can I download the spreadsheet? I'll tell you that at the end of the webinar, or near the end of the webinar. So just hold tight for a couple minutes, then you'll figure out where to get it. Yeah, then finally, financial health, which is an interesting one. It's mainly based actually on me reading the book that I linked here at the bottom. I'll copy this link and paste it in the chat. Let's see, is this the link? Yeah, there it is. So that's actually a link to a blog post I wrote on my website with it's about the book, and it explains like why I used all these metrics here. What it actually does, it sort of he came up with new names for existing things, which is a bit confusing. Like accrual profit is similar to net profit, and defensive profit is similar to free cash flow. So what he does here is he compares net profit to free cash flow. Why? Because if your net income, your net profit, your net income is consistently higher than your free cash flow, that is in theory not possible, because how can you make more profit than there's money coming in? So if that's consistently that way, it just means that they're probably cooking the books, which is a warning sign. It could be trouble. It's like how the book actually is all about, can you identify the next Enron before it happens, And he used all these metrics for that. And one of the other things is the debt repayment period. Another metric he came up with in the book, it's how many years does it take this company to pay back all their debt using their free cash flow? This is 0, which is amazing because that means they don't have any debt. Then the Altman Z score, it's a classic score used to figure out how likely it is that a company goes bankrupt in the next couple of years, which is also green in this case, so pretty good. Yeah, Mike says cash flow can be more. That is very true. What I'm saying is that cash flow cannot be a lot less than net profit for an extended period of time. It can happen for a year, it can happen for 2 years. If it happens for more than that, something is fishy, at least. And it might not be 100% sure that something's up, but at least it's worth your attention. And that's what I'm trying to do here. Trying to give you a, better handle to see like, oh, something is turning up red on the dashboard. Let's dive into that particular thing. So instead of having to analyze every single figure in the financial statement, you now have a very targeted way to see like, okay, return on equity turns out to be bad for Dolby. Why? Look at it, but the debt to equity is very good. It's because they don't have any debt, so you don't have to look at that anymore. That's just how this speeds up this process. But right now I talked enough, I feel, so let's get to it. Which stocks do you guys want me to analyze? I already see Mike, you said AZO. Remember, it only works for United States stocks, so listed on the New York Stock Exchange or NASDAQ or any of that stuff. So let's fill in AutoZone. Takes a couple seconds. There we have it. Yeah, so what we see, return on equity is good, debt to equity good. I don't pay much attention to this one. That's why. Oh, that might also be interesting to explain here. This last row, you see the score is calculated, 68. It's based on these points. Then there's this weight column, which means that, like I said in the beginning, there's a lot of value investors, and they all have their own, they all apply value investing strategy, but they all have their own little tweaks to it, So for example, for you, maybe the PEG ratio is not important at all, like it is to me. So I gave it only a weight of 1. But what if I gave it a weight of 10 because it's super important to me? Then you'll see that the score will change. See, it went down from 68 to 59. It recalculates all the scores based on how important each of these metrics is to your particular style of investment. So this is just the defaults that I put in, but you can tweak it to whatever you want. Yeah, so let's just quickly look at it. Book value per share is bad. Why? Let's look at the graph. Book value per share is dropping like a brick, and it's in the minus. This is not good. This is not good at all. Negative book value, I don't think I have seen that very often. I have to look into this a bit more to figure out what exactly is going on here. But I also see the current ratio, which I talked about before. It's below 1, which means this company is not able to meet all of their short-term obligations. So what's going to happen there is probably, it's going to be tricky. Okay, but enough about that, because I see a lot of other stocks. Apple, of course, just launched a new iPhone. Not sure what you guys think about it, but I think it's an overpriced piece of tech. Looks good, of course, but okay, 83, pretty good. Debt to equity average. Let's see why. If we go to the inputs, we see that the debt to equity is 0.54 at the moment. The reason why Apple actually, you would think like, why does Apple have debt? Like you see here that from 2006 to 2012, Apple didn't have any debt, and then it started accumulating more and more and more and more. The reason they're doing that is because they have a ton of money, but it's overseas. And if they want to use that money, they have to transfer it back to the States. First have to pay a ton of taxes over it, and then they're able to use it. So for them, it's actually cheaper to get into debt and pay an interest rate than to use their own money, which is crazy, but it's the way it is. Other than that, you see all the figures are green. They're doing great. Like the analysts expect Apple to grow for 7.8% for the coming 5 years, and that's what these valuations are based on. And based on that, you see that the average estimate, the intrinsic value estimate, is $152. The current share price is $115, which means in theory, Apple is currently undervalued 32%. Interesting. It's a good stock. I have it in my portfolio too. Yeah, Jacob asked for back, but I think this is a bank stock, isn't it? It won't really work well with bank stocks because, the thing with bank stocks is they have very weird balance sheets. They don't even know how much they're worth themselves. So how can we know? Like it's just, there's very complicated calculations you'll have to do to figure out the value of a bank stock. So I would recommend not like Warren Buffett too. Like he got into banks when the crisis hit, but other than that, he sort of stayed away from it. And I do too. Oil and gas, Phillips 66. Return on equity bad. Book value per share bad. Let's just quickly have a quick look here, see what's going on. Return on equity has been increasing. It's now pretty good, but it used to be very low. So on average, over the 10 years, it still says it's bad, but it's definitely going higher and higher. Yeah, this one actually has potential. Current ratio going up, profit margin going up, book value going up. So yeah, it's worth a second look. Let me see. What else do we have? I'm trying to go through a couple of them, but I see a lot of, like, I'll just quickly go through some of them because I can't. I'll try to go through all of them. So Rajat said, why is the default weight set as it is? It's just my personal preferences, really. That's just based on my research, based on my, like, I've been investing since I was 13. I'm 26 now, so that's 13 years I've been investing. And in those 13 years, I developed my own little strategy based on value investing, and the metrics as they are set now in the spreadsheet, that's my preferences. Whoops, I think, yeah, okay. I just unplugged my HDMI cable. I lost my screen for a sec. Okay, Infosys. As you can see, there's wildly different valuations here, from 12 all the way up to 1,000 or almost 1,100. So let me just quickly figure out why. Discounted cash flow. They have a ton of cash flow. That's great. But then when we look at the price earnings ratio, we see that they don't have a ton of earnings per share. So the earnings per share are quite low. In this case, honestly, if they're only, let's just look at the last 10 years for a sec, right here, earnings per share. It's over here. Yeah, like this is a typical case, right? Where the value you get from Google Finance is not the same as the value you get from the key ratio. So in this case, you can use the override field to just fill in the one that is correct to get a better estimate. Because if you see wildly different valuations like this, there's probably something up with the data. Because even the big data providers, they don't get their data loaded into their database straight away. Like a company reports its earnings, it doesn't go straight into the Guru Focus database. There's actually, I've talked to guys who work there. There's actually an army of people like filling in that data manually still, and it sucks. So there's still errors made, even though they have a ton of quality checks. Like once in a while, an error slips in. Let's see, Starbucks. Mark asked for that one. So 74, pretty decent. Valuation is close, like the average valuation is 47, which is slightly below the current share price. It's not really cheap at the moment, so not really worth looking into right this moment. John, I see you asked for Staples, but I don't know the ticker symbol just from the top of my head. So if you can look up the ticker symbol, I'll be able to look it up. Let's see. What other ones do we have? Nestle. Same for Nestle, Kavi. If you have the ticker symbol, I can fill it in. Jacob, KMI. KMI. Kinder Morgan. Wow, this one is terrible. 2.27 out of 100. That's not very good, is it? Everything's red. Yeah. Not sure what to make of this one. This is just swinging up and down like crazy. As a value investor, that's very hard because if something swings up and down, it's very hard to make a prediction about the future, right? Like if a company makes a steady, let's say 100 million revenue each year for the last 10 years, then it's relatively more it's relatively more easy to make a prediction about how much it will earn the next year, but this is just impossible. It's swinging all over the place. So I would definitely not waste a single minute on analyzing the stocks further. This staple SPLS, is that it? Oh yeah, there we go. As you can see, it just takes a couple seconds to load all the data, but same here, like it's PE is valuation is negative, which means that they have a negative earnings per share, or in other words, they made a loss this year. Also, companies that make a loss, it's just impossible to predict their future income with certainty if they're making a loss, So what you're looking for, and as a value investor, you have to realize there are tens of thousands of stocks, but you'll probably only be interested in a tiny fraction of them because not many of them meet all the criteria. Like, is this a great business, performing steadily above average for the last 10 years? And is it also cheap? So there's not a ton of companies that meet those criteria, especially not now, like after this long uptrend of the markets. It's hard to find real bargains. So let's BNDP, Indo International PLC. Just trying to, it can't find all the data. It's Okay, let's see. UTHR, United Therapeutics. Heard a lot about that. Yeah, did you see it here? Like I already saved it in the spreadsheet because I did a webinar before, and yeah, someone also mentioned that stock. It scores great, like a 91 out of 100. That's amazing. That's a great score. It just says that the return on equity is inconsistent. So let's see what it means with that. Yeah. So as you can see, it's great now. Return on equity above 40, which is amazing. But it has fluctuated a lot, and it came from a negative even here in 2008. So that's why. But you see that book value per share has been steadily increasing. Profit margin is extremely high, above 40 as well. This is a very interesting stock. It's wiggling around a bit, so it's hard to make it off their value. That's why you see there's a bit of a discrepancy here. But even if we take this lowest valuation, it would still mean it's undervalued compared to its current share price. So this is one I would definitely try to look into a bit more if I was you guys. Alibaba, wildly different valuations. PE ratio is not very good. Why not? Let's have a look at the analysis. PE ratio is at almost at 37. It says currently trading at a multiple above the industry average. Yeah, a PE ratio of 37, that's extremely high. I personally try not to buy anything at a PE of more than 20, preferably not more than 15. So 37 is a bit much. Book value per share. Let's have a look at that real quick. Alibaba is an amazing company, of course. As you can see, I think it's just because there hasn't been data for these last couple years regarding book value per share. So that's why it says it's not very good. But as you can see, it's skyrocketing. So that's why it's always good to double check everything. I'll just do a couple more and then I'll show you where you can get this spreadsheet. Skyworks, wow, I'm gonna write this one down too. 85, very good. Based on valuation, it's probably not cheap at the moment. Average estimate, yeah, let's just say the average estimate is closer to 80 in this case. It would be undervalued by 4%. So not a big profit potential there, but it's a great company, so keep it in mind. Yeah, so WFC, Wells Fargo, another bank. It's gonna be hard to, yeah, thought so. They just have different balance sheets, as I said. That doesn't work. Google Alphabet, it's called now. Almost forgot about that. Yeah, it's always hard to bet against Google, isn't it? It says here, like, based on these estimates, it's currently 30% overvalued. But are you actually going to short Google? I mean, I wouldn't recommend it, So let's do one more AMD, just because Advanced Micro Devices, not a very good contender, I think. 45 out of 100 and not very great valuations either at 0. NRG, last one. This one have a nice one as the last one, but also this one looks terrible. The negative PE valuation. What's happening here? Minus 20 earnings per share. Yeah, that's not gonna make you rich, Yeah, Rajat, Chipotle. What's the ticker symbol for that? WMT. Okay. Walmart, of course. Sometimes you think the ticker symbol just doesn't make sense, but then once you see it, so takes a bit to load all this. There, CPL, Chipotle. Having some issues with the internet here at the moment. Oh, this ADR, that's not yeah, that's not in the US. Nike then. In the meantime, let me just quickly show you. Yeah. So this is the value spreadsheet. Let me just quickly, because I see it's already almost 8 o'clock right now. So we have the value spreadsheet. I just showed it to you. It contains 3 valuation models. It's 100% unlocked, meaning that you can. Um, After this, I'll do a couple more, maybe a couple more stocks, but I'll just quickly go through this for people who have to leave at 8. So the spreadsheet is 100% unlocked, which means that you can change every single field and formula in the spreadsheet. So there's nothing behind like closed doors. A lot of these there's a lot of web platforms where you can get financial data, and they're just as is packages. Like you have to do it with what they have. But I know a lot of people who invest, they work with spreadsheets, so they might want to add their own formulas, and you can just use the data that I'm pulling into this spreadsheet and just add your own formulas or even change a couple of mine. As you saw, it has built-in fundamental analysis. So you don't have to look through every single number, but no, it just shows you on the dashboard and on the analysis tab, like, okay, this is good, this is bad, to quickly analyze stocks. It contains a lot of financial graphs, as you saw. It comes with free updates, so whenever you guys request, like a lot of you guys request a new feature, I will add it, or if it stops working, I'll fix it, and you'll get that free of charge lifelong. And yeah, you can always send me an email and I'll usually reply within 24 hours. So the regular price for this thing is $297, but because I want to thank you for being here with me, listening to me, sharing this presentation with me, I have a special offer for $197. And I know it's still a lot of money, but keep in mind that this is a one-time fee for lifelong access, where a lot of other financial services, they charge you this a month or more. And so you just pay it once, you have lifetime access to updates and all this stuff. Yeah, so how do you get that? Go to valuespreadsheet.com/big deal in capitals, otherwise it won't work. And I'll also show it in the next to the presentation right about now. So yeah, and because the normal price is $297, I can't have this offer up for the whole time. So I'll just have it on for 72 hours after this webinar. Yeah, so go to valuespreadsheet.com/big deal to make use of this this special offer. And for those of you who have been on my email list for a longer time, you guys know that I never promote products at all. Like my mailing list at this moment is, like very big. We have like over 20,000 people on there. And so a lot of companies contact me and they say like, okay, I have this great investment product. Can you please promote it to all your users? And I'm like, no, I won't, because I don't know if it works and if it will get results. And that's the thing with the value spreadsheet is I built it myself. I know it works because I've been using it for several years now. And I wouldn't recommend anything to you guys if I didn't fully believe in it, because it would be very easy for me to make some extra money by just promoting all these products that are thrown at me, but I just won't. I just only say that this is something I built for myself years ago, and I've been using it for years, and only then I thought, well, maybe other people are interested in it too. So it wasn't made as a product initially. It's just something that I made for myself. So I made it to it had to work, because otherwise, why would I use it? Why would I keep developing it? So I truly believe in this product, and I think this is a great price, especially compared to other products in the market. And you get a lot of it in return. And just realize that even if this only helps you to buy one good stock or to avoid buying one crappy stock, you'll already have earned this money back, So in the end, it's worth it, I believe. Otherwise, I wouldn't offer it to you guys. I swear to God. So valuespreadsheet.com/big deal in capitals to make use of this offer for the next 72 hours. And yeah, I think, let me see if there's any questions about this. I'm making one based on Indian stocks. That's great, Kavi. Like, there's a lot of Indian people who ask me that. Like, does it also work for Indian stocks? Unfortunately, not. Also, Canadian or Singaporean stocks. Like, I wish it worked, but the data is coming from the websites I just showed you: Guru Focus, Morningstar, Google Finance, Yahoo Finance. So they don't all support Indian stocks, So it took me, like, I built the first version of the spreadsheet I built in, I think, 2-3 months. And then I've been adding to it over the last 4 years now. So yeah, there's a lot of work in here. Thanks for your time. Yeah, I wish it worked for UK stocks too, Mike. Unfortunately, no. Only US. And this price is in dollars, US dollars. Yes, it will not work for markets other than the US again. Yeah. yeah. I understand that. Check what you're saying. You might have to stop drinking Starbucks for a while to afford this, but in the end, it will be worth it, I'm sure. I want to thank you guys for your time as well. It was great having you all here. Please, I can stay around for another 5 minutes. Just ask me any questions you have regarding the spreadsheet, regarding the offer, regarding value investing in general. I'm here for another couple minutes, so feel free to fire away. And if you don't have any questions anymore, I want to thank you all for being here. It was great having you here. And yeah, I mean, I had a good time. I hope you guys learned a thing or two. I hope I gave you some nice resources you can use to further your investment journey. And whatever you do, never trust a single source of data. Always double check things. Always. I mean, once I bought, when I just started out, I once bought I built a spreadsheet, my very, very first spreadsheet. I did a calculation and I was like, wow, this company is great. I have to buy it. It's so cheap. So I did with my hard-earned savings. And what happened was that the company had a stock split, but it wasn't yet update on the website I was using the new earnings per share yet. So I was using earnings per share from before the stock split. So the earnings per share were a lot higher than after the stock split. So I got wasted there because I used the wrong inputs, the wrong data inputs. So always double check things before you make a purchase. But I do believe that this spreadsheet can truly speed up things, make your life a lot easier. And plus, like, if you can analyze 100 stocks in an hour versus one, it just makes you that more likely to find that hidden gem. The more stocks you can analyze in the same amount of time, the more likely you are to find that great unicorn stock. So I truly believe it will help for that. Thanks everyone for being here. Let me see if there's any questions. Thanks, Chuck. Does the spreadsheet also work for MLPs, CEFs, and BDCs? Well, Ilya, if I knew what they were, I could tell you, but I have no idea what that stands for. It works for stocks. Let me say that. Like, it doesn't work for it doesn't work for ETFs or any of that stuff. But it's for stocks, US stocks. That's it. Okay, Kavi, Will, Mark, everyone, thanks. I'm gonna end this broadcast, and yeah, have a great rest of your day. Thanks for being here. Bye bye.